Good afternoon, everybody. It is Brian Shannon here from AlphaTrends.net. Let's go ahead and take a look at this market. We've had some real volatility here lately, just underneath that 50-day moving average. And today we came and touched that widely watched moving average again from underneath and touched upon it, and then like an electric fence jumped away from it real quickly. So let's take a look at the internals here. Well, let's take a look there at that since I have it up on the screen. The TLT 20-year bond index was obviously when Bernanke spoke. That's really when the air came out of this market and people fled to bonds. So the bond market is still continuing in an uptrend, innocent till proven guilty, above this rising 50-day moving average. I remember a couple weeks ago, right in here, a lot of people were calling that the end of the or the peak in bonds, and obviously we're continuing higher. So these trends die. They don't die easy. Higher highs and higher lows, and in the S&P 500, we still do have this pattern established and intact, which is lower highs and lower lows along that trend line, and that trend line also happens to be where we find that 50-day moving average. Today, Bernanke was talking about unusual uncertainty in the economy and the markets, and what I pointed out the other day was just kind of very similar. Is a lot of people have been calling this a head and shoulders pattern. Personally, I don't think it's still a valid pattern because we had this move below the neckline and it came back above. But I was also pointing out that you could look at this as a potential inverted head and shoulders pattern. So it goes to show again that what pays in the market is not recognizing patterns, because two people can look at the same exact data and come away with very different conclusions. You could say that breaking this neckline and getting back above the this peak right here, then we could be heading higher. And I kind of agree with that. That yesterday's lows, that is on Tuesday, that's going to be an important level. That has the potential to be the higher low from which we make a higher high. And in order to get a higher high, we need the market back up above this 110.35-ish area. So the market remains really in this area of heightened uncertainty, is what I'll call it. There's always uncertainty in the markets, but we've got earnings reports, obviously, that have come out, and some of them have some of the stocks have responded well, and others kind of not as well. I think generally the reaction to earnings has been fairly positive. Apple was the one that reported last night. It gapped up and saw its highs in the overnight session, actually, but sold off. And Apple just seems like it's still within this bigger range, and just not a whole lot going on in there. It's right to the midpoint of that range. So I don't think it's I don't think it's a good buy here, and I don't think that Apple is probably very dangerous in this area as well. To me, you focus on where the better opportunities are, and right now we're going to see a bunch more earnings coming out from big names. We've got Baidu and Netflix coming out. I thought maybe Amazon was as well after the close today, but it's going to really depend on getting through. This week is the heaviest week for earnings reports. The majority of companies will be reporting, and then it begins to slow down somewhat. And I think I heard that tomorrow is actually the heaviest day of earnings reports for this cycle. So we've still got a lot of risks based on the individual stocks and their reaction to the earnings. And we've also obviously still got these macro events that have a lot of people worried, and have a lot of people moving big pieces of money around based on where they think the economy will be 6 months from now. And right now, it's still uncertain. We look at that weekly time frame, and I've still got those. I guess it holds on to them, but the market bounced from that 38.2% retracement level. It's trying to hold on in here, and if it can make a higher high above this 110 35 area, then we would be looking for a move up to the next potential level of resistance, and 113.80 I believe was, or 113.60 maybe was that level. But the market is, it's been wounded pretty deeply here over the last several months, and it's still best case scenario I think is that it's undergoing a correction through time, whereby we see this back and forth volatility that wears people people out, and from there, the stocks move into, as they call them, stronger hands. So the stocks move from the weaker hands, or the shorter term traders or people without conviction, and then they into the hands of those who are willing to hold on longer term and be investors. And personally, when you see this type of volatility, our job as traders, or the way I view it is our job as traders. Maybe you're an investor, but the job of a trader in this environment is to trade and to keep these stocks on a short leash and wait for the opportunities when we have a trending market again that allows us to hold things longer term. But until then, it's just been a whip fest, really, just back and forth. We had big down day on Friday, big up day this Tuesday, and now a big down day today, down 1.3% on the SPY. So when we look at the 10-minute time frame, we can see that the market did get back above that 5-day moving average yesterday. Still had a slight slope to it lower, but then this morning we had broken first that level at 108, and I was saying on the on Alpha Trends this morning, on the chart I had posted there, that the more important level that I would have liked to see hold on a closing basis was this 107.55 area, and obviously we're below that. We closed below it, and we've got a pretty ominous look in here, looking like a bearish, little bearish flag in here on the 10-minute time frame. Now for tomorrow, I think that what we're going to see is that this 107.55 area is going to become important again, because not only was it this prior resistance and support on Tuesday afternoon, but we had broken down through that today, so it has the potential to become resistance, and it's also the location of that declining 5-day moving average. So I think if we get a bounce tomorrow morning up towards this 107.50, 107.55 level, you want to be very cautious in there and look for a failure, because a failure in that area would be a great opportunity to be able to sell short with a stop pretty close by. And from there, we would be looking at the next level, which would be 106. And 106, what do we have here on this 30-minute time frame? Well, we can see we have this high here. We have a lower high, and for William O'Neill fans who popularized the cup and handle, well, here's an inverted cup and handle. If it gets down to that 106 level and it breaks it, then we will probably unravel pretty quickly. Of course, 105 is 104 and a half actually on the daily time frame is an important level, but looking intermediate term, it's not looking pretty. It's not very looking very pretty in here. The psychology again of any type of pattern like this, where you have more, where you have, first of all, you have a test of that 106, the market rallies up to 110, and then it drops to 106 and rallies back up, but this time the rally only got us to about 109. So it showed us that the sellers were more aggressive price wise in here. They weren't waiting for the people who were long weren't waiting for 110 to sell their stocks. The shorts weren't looking to offer out at 110. Instead, they were offering at 109. So they were getting more aggressive price wise. And now when you look at it, you see that the test between this 106 took about, the first time, 1, 2, 3, 4, 5, 6, 7 days. Now here we are going to be back there maybe tomorrow, 3 days later. So they're getting more aggressive time wise as well, as the pressure mounts from this declining 50-day moving average. And last week or 2 weeks ago, we had seen the death cross, as people call it, the 50-day coming down through the 200-day moving average. From there, the market had a real nice rally, I mean almost perfectly. And today we had seen the death cross in the NASDAQ. Now in the NASDAQ so far, it's looking a little bit more ominous. The 50-day moving average crossed down through the 200-day moving average. But when you look at it beyond just those longer term moving averages, we've still got the same type of downtrend line in the NASDAQ that we've seen in the SPY, and we see that we're in this area where the 50 and 200 day are coming together, and that's where the sellers seem to be congregating. However, we look at it objectively. Again, the market has had some support down near 42. That's an important low, but after this rally here, Okay, we've seen this market come up and make this higher low. Today it was trying to make a higher high as it gapped up, but it couldn't get through that level. Now getting back up and closing above 46 or so, that would have probably put the short sellers really on the defensive here, and we might have seen this market rally up towards 47.75 or so. Might have, but it didn't happen. So that's just all kind of in the rear view mirror right now. Again, technical analysis isn't necessarily about predicting what's going to happen next, but instead look at it and say, what's the psychology of this? Well, the sellers are getting more aggressive price wise, they're getting more aggressive time wise. We're coming into this 106 level. If it breaks there, then what could potentially be next, and what do the odds favor? What do the odds favor with a declining 5-day moving average? Odds favor further downside, and we see this, let's just look at today's action. We see that this late day action, it got pretty choppy in here, but when you back it up to even, let's say, a 5-minute time frame, it's looking more like a bearish flag that could continue to see this market, call this point A to point B, right, and then call this point C right up in here, and we would take a measured move objective. The height of this A to B would approximate the target for C to wherever D ends up. So it's not looking as though the market should be able to continue higher. I said that on Monday as well. I said it doesn't look like this market's going to, Monday after the close, I said it looks like the odds favor further downside. Then we had a huge up day after that gap lower. So if we take a look at since this gap lower, that seems to be a pretty important event for the market in the short term. So what we want to do is say, well, since that event, who's in control? Well, since that event, what we want to do is we want to take a look at the volume weighted average price for the last 2 days. The volume weighted average price for the last 2 days is right here at about 107.50. So from the last 2 days, the average long participant is now losing money. The average short position that's been put on in the last 2 days doesn't mean everyone. I mean, if you shorted down there, obviously you're losing, but on average, and that's just trying to determine the psychology of the average participant, the average short is in a good position in here. So when we come up with that, that 2-day volume weighted average price comes in right at that 107.50 area. That's also approximately where we see this prior resistance, which was support in here, and the location of that 5-day moving average. So it stands to reason that we would think that sellers would defend that level, buyers would maybe back off in there, and that could potentially be a good point to short against tomorrow. I don't like to short on the rally as it gets up towards there. So in other words, let's say here's our close today. Let's just kind of draw this in. So here's our little bearish flag, let's just call it. So let's say we get up to that 105, and this would be tomorrow, 105.55. I wouldn't short it there because maybe it just keeps going like this. Okay, instead, I would want to see that it gets rejected from that level. We get back below tomorrow's volume weighted average price, and then from there, a pattern of lower highs and lower lows comes in. And then, if I was short, we would hope that it would just completely cave in. But right now, that's the way the S&P 500 looks. Not too good. But you could make a case that if we do hold on above that 106, we have a higher high. A higher low, and we could push up through here. So we have all of this unusual uncertainty, as Chairman Bernanke calls it, and it's telling us from a stock perspective that we're in this area where there's this battle being fought, and the winner of this battle is going to be either the shorts get squeezed and the market reverses the course that it's on, which is less likely, or the trend continues, we break through this support and continue lower. So, a trend once established is more likely to continue than reverse. That's basic technical analysis. And we have an established downtrend. We have lower highs and lower lows. We can look at the what-if scenarios, but don't trade the what-if scenarios. Understand, try to think of what are the potential scenarios that could unfold, and then develop a plan based on how they would unfold, and and have a backup plan in case the market doesn't agree with our analysis. Russell 2000 not looking good, obviously, either. Still in this pattern of lower highs and lower lows, and even here where it made this slightly higher high, from that failed move came the fast move. just below that declining 50-day moving average. So even if these markets make these higher highs, I think we still need more time before a real sustained rally could take place. We need, the market still needs time to heal. That's the best case scenario, is that we heal more through time. Otherwise, we have to still look at it as, we've had these rallies in this downtrend, and there's really nothing more than hope to suggest that it will turn higher. So trade each stock on its own merits, obviously, and understand the dynamics of what's happening as far as when the stocks that you're looking at report earnings and that sort of thing. The semiconductors have been in this range of 25.5 basically up to 29. They've been spending some time in here this week, right in the midpoint of that, right at this 27.50 area. You can see when I clear that up, that's where we have that 10, 20, and 50-day moving average as well. So the semiconductors are more neutral. You could make a bullish case above $29 a share, though, that this would be an inverted head and shoulders pattern. That's something that worth keeping an eye on, because if the semiconductors were to reverse in that way, it would drag a lot of the rest of the market with it. The financials, kind of looking like the same type of thing, with 15 being their potential neckline. And you look at this and say, well, is that an inverted head and shoulders pattern? Well, if it is, you don't do anything with it now. It's just something worth noting that here's a potential scenario for a turnaround. This 15 is, whether you look at an inverse head and shoulders or not, it's an obvious level where we found sellers. And, today we came, we got back down, or we gapped up above that declining 5-day moving average, and then from there it was just a real nice pattern of lower highs and lower lows. When you look at that 1 minute time frame, it held below that volume weighted average price pretty much all day, except for about 5 or 6 minutes. So all these markets are badly damaged, and best case scenario is that they're going to need time to heal. The one exception, obviously, is the TLT, the bond markets. People are fleeing to safety, but that safety doesn't necessarily mean what a lot of people expect, which would be gold as well. Gold, I've been talking about that as what I think gold is in for is at a minimum a test of this trend line, or that 200-day moving average down near 113. Gold is still looking like it's heading lower. So I wouldn't be a buyer of gold based on any flight to safety type thing. The retail holders, we've talked numerous times over the last several weeks about them with these lower highs and lower lows. Now we've got the 10 and 20-day moving average crossing in here, so it's showing maybe a little bit more of just some stabilization and indecision. So I think that maybe in here the worst could be behind for it, but I definitely wouldn't be a buyer of the retail stocks. They're, even though they came down to that 50% retracement and all that, they did rally up and find resistance at this prior support. So retail holders, they're going to need a lot of time to heal. Let's take a look at some of the comments on here, and let's see. Anyways, thanks Jay Stan for the retweet. Also, Stock Twitch TV. Javier is saying, how about my thoughts on ESRX? How about we take a look at Express Scripts? Just looking at the daily time frame, it looks like the stock broke down. This support became resistance, and we had seen this little stage 2 rally up, and it broke support. Now it's in a stage 4 decline on the short-term time frame. So let's take a look at that on a 30-minute time frame. So here was our bigger break of support at that 49 level, and here's what so I guess it was about 48, 49. Then we go to the 30-minute time frame to zoom in on that. We can see here that we had this stage 1 accumulation, stage 2 markup, some distribution in here, and then we broke support, lower highs and lower lows. So it looks like to me the stock is trending lower. It's down at what's been an important level earlier this year. So I think that it's looking like the best days are behind for Express Scripts. It's been a huge mover the last several years, and it's had some breaks like this, but I would say that you have to look at it from a near-term perspective. It's stuck below that 200-day moving average. I think it's guilty till proven innocent. I definitely wouldn't be a buyer. And Chart Diva is saying, Amazon's tomorrow, thank you. Today is Baidu, ISRG, eBay, and Netflix. And let's take a look at, I wanted to look at ISRG actually. Let's see if that one's trading yet. This stock just kills shorts typically on earnings, but you can see in the after hours trading here, we are down at 297 after closing at 316. So it's under $300 for the first time in a while. Express Scripts. So let's just draw a horizontal line at $300 a share to get some perspective on that. So it's below that $300 a share for the first time really this year. This has been just a powerhouse stock on earnings typically. But you can see here that the stock has, on this weekly time frame, it has this tendency to have these big runs. And I meant to go with my regular trend line. It has a tendency to have these big runs, followed by uncertainty, and then that decline, stage one, and then this big uptrend. So it looks like we're kind of maybe topping out in here, at least intermediate term in ISRG. Let's just take a look. Netflix. Let's see if we're getting any action in there. Closed at 119, so this isn't looking good. I mean, these are some of the big leaders. Netflix down 10 points basically. Was that right? 10 points. ISRG down whatever it was, 17 or so. eBay, I don't know. We're not going to look at eBay. eBay is a little stock these days that I don't think many people take too seriously. Baidu, I think a lot of people left eBay for dead long ago. But Baidu closed at 73.31 in the regular session, and it doesn't look like they've probably it's either halted or they haven't reported earnings yet. By the way, I don't know if anyone knows, but it's curious to know if stocks are being halted in the after hours if they're down 10% after earnings. But anyways, thanks Chart Diva for that information. Long horizon, what do I think about KFN? KFN, is that Corn Ferry or something like that? It's got a goofy name. Oh, it used to be. Anyway, KKR. There was a company named Corn Ferry, I think. I never understood what that was, but anyways, the name made me laugh. KKR Financial, looking like it's had this big rally, real nice uptrend, and this is going to be the last stock we take a look at, by the way. Let's see. This KKR Financial, it's looking like it's just turning sideways, but with some downward pressure with these lower highs on the weekly time frame. So these are those lower highs. So it's really looking more neutral than anything. I don't really see much of a reason to get involved in this stock. We've got these moving averages crossing. It's stuck in a range. It's a low volatility stock. So so maybe a slow multi-month consolidation. And Hoya Mustang, per Alpha Trends on his stock Twitch session, this market's designed to wear you out. Patience is key. Marathon mentality, not 100-yard dash. Hoya Mustang, I think that we just see things differently, because me personally, I'm not a marathon runner. I like to get it done with. I like to go have a cold beer at the end of that 100 dash, and then look and warm up and wait for my next race. But my mentality is in this, that either you have to be either super patient and be willing to accept some very large unrealized losses in this market, and you're also gonna you have to have a lot of faith in a lot of things to be long this market for the marathon. You have to have faith in our financial system. You have to have faith in the integrity of our markets. I don't have faith in either one of those. My personality is that I really don't trust the market, so I'm a short-term trader. That's how I manage my risk. So I think we just see things differently, and that's fine. That's what makes a market. Anyways, that's gonna do it. Let's talk again on Friday. Thanks for tuning in, everybody. Hope you're making money in this market. It's definitely a difficult market. It's testing a lot of people's patience. And again, we'll talk on Friday. Thanks.